Well, the Fed delivered a 25 basis point cut last week and signalled a front loading of easing going forward, boosting equities while seeing the dollar gain some ground as well, and also allowing the Treasury curve to steepen. While elsewhere, the Bank of Canada and the Norges Bank delivered rate cuts of their own, but the Bank of England and the Bank of Japan stood pat on rates for the time being. Looking ahead, a lighter docket awaits this week, with the economic calendar lacking much of any interest or releases likely to impact financial markets, potentially meaning that it's up to end of month and end of quarter flows to drive proceedings over the next 4 or 5 trading days. In any case, there's plenty for us to discuss on the trade-off this week. So without further ado, let's get on with the show. So certainly a busy and chaotic week in the financial markets last week. I think most participants will be glad of calmer conditions to allow them to take a little bit of a pause for breath this week. In any case, joining me to work out everything that's going on is my good friend Ryan Littlestone from Forex Live and Forex Analytics. And Ryan, I'm just going to pause momentarily and allow you a brief moment to protest before we kick off the show properly, because that seems to be what West Ham fans are doing these days.
Oh. Enjoy it while it lasts, mate. Enjoy it while it lasts. I'm sure we'll hand you a result on the 4th of October in a couple of weeks. I'm looking forward to that one. I'll be up there. Are you going to be up there?
I won't be, no. But I tell you what, until about the 92nd minute yesterday, I was about to impose a ban on any mentions of football yesterday, but on this show. But mercifully, we came through in the end.
Yeah, typical gooners.
Oh.
Yeah. Mumble, mumble, grumble, grumble.
I was going to say, right, we'll leave Victor Meldrew on the south coast to it, and the rest of us will move on to Topical Thunder. Right then, let's start with the Fed. Definitely the main event of last week, and as expected, the FOMC delivering a 25 basis point cut, lowering the target range for the Fed funds rate between 4 and 4.25%, and also, as expected, the new governor and Trump puppet Steve Moran dissenting in favour of a larger 50 basis point move. I guess maybe it's surprising that he only dissented for a 50 basis point cut. As we discussed last week, though, that wasn't really the focus. That was very much priced in a month or so ago now. All eyes really on the policy outlook. And I think on that front, it's pretty clear that the Fed want to move pretty quickly back to a much more neutral setting of the Fed funds rate. I would point to two pieces of evidence to support that view. Firstly, the committee removing reference to the extent and timing of additional rate adjustments in the statement, which very much suggests that a cut is going to happen at the next few meetings, probably until they add that language back in at some point in early 2026. And of course, you then had the dot plot, which pointed to 75 basis points of cuts in total this year. 50 basis points of those haven't been delivered yet. We've got 2 meetings left to go. I'll let you do the maths as to when and where the Fed are likely to cut next. The dots did, though, point to 25 basis points of cuts in each of 26 and 27. So ostensibly a slower pace of easing next year and the year after. But I think anyone seriously believing that they're going to deliver 3 cuts and then stop, or even 4 cuts and then end the cycle in January of next year, is probably barking up the wrong tree for the time being, given that the Fed are quite aggressively leaning in now to support the labour market. It's clear that their reaction function has very much shifted to that side of the dual mandate. The new summary of economic projections really reflected that: a marginal upgrade to their GDP growth expectations, a downgrade to projections in terms of unemployment. Of course, the cost of that, if you like, is they are going to tolerate higher inflation for the time being, but they do still pencil in both headline and core PCE reaching that 2% target in 2 years, although I'm sure there are many people that are debating whether or not that will actually happen in reality. But I think overall, the take from the FOMC is they're going to run it hot, and they are wanting to lean in hard to support the labour market, which does look to be stalling. Payrolls growth is basically nil, certainly when you strip out healthcare. Unemployment was at a cycle high in August, and we get the next jobs report next Friday. They are wanting to lean in hard to support economic growth. And of course, this comes with the underlying economy already looking pretty solid. So you've got this really nice combination of a solid underlying US economy, really robust earnings growth, and now a Fed who are saying effectively, we want to make that more robust and more solid by giving you a looser monetary policy backdrop much sooner than we'd expected. And in my mind, that is about as good a mix as you can get in terms of risk assets. And last week, incidentally, I think it was Thursday, we had the S&P, the NASDAQ, the Dow, and the Russell all closing at a record high. And I think it's something stupid like 15 times this century that's happened, which really speaks volumes about how the market's taken the Fed meeting last week.
Yeah, I'm not sure I will remember the other 14, but there we go. But yeah, I mean, this was a bit like Bank of Japan policy. Yeah, this one was we knew it had been building up over the last 2 weeks, coming back into September and in the summer holidays. Everything was building up to that Fed meeting. The price action before it, after it was, I'd like to say surprising, but it wasn't too surprising because the market was going in looking for something a bit more dovish than it got. It reacted negatively right on the announcement when it saw that there were 3 cuts penciled in for the year, including the September one, which was one more than they expected previously. But everything else wasn't dovish at all. As you say, they marked up inflation forecasts, they marked up GDP, they lowered the unemployment rate. Now, if you're that worried, if you're doing a rate cut because you're worried about the unemployment, you don't then go and lower your unemployment rate forecasts. So, yeah, we knew they were going to get panicked over this one. It was a question of how panicked, and they didn't really panic at all. But as you say, whether they do one cut next year remains to be seen. I think that's probably a little bit too pessimistic, shall we say. But it all comes down to the data. So, yeah, the reaction was a dollar sell-off for about 10 minutes. Then power started and we ripped the other way and continued ripping, until even today. So, yeah, it was good for volatility. That's what we want in a central bank meeting. Probably the biggest one for price moves we've had all year.
Yeah, just caused everyone a headache, to be honest. A bit of whiplash. The one thing that we should mention just before we wrap up on the Fed, you mentioned the dots, of course. Steve Moran, who I alluded to earlier on, putting in a dot pointing to a further 125 basis points of cuts this year. I mean, it's quite frankly ridiculous at this point. He came out on Friday to say, yes, that lowest dot is mine. I don't think anyone really needed him to confirm that. But the one sort of takeaway from it, I guess, if there is one, is whoever Trump picks to be Fed chair next May, and you'd expect that announcement to come within the next couple of weeks, you would hope, they are very much going to be in Moran's mold. So I think the risks to the base case, or at least the risks to the medium path in that dot plot, do point in a decidedly dovish direction in my mind, at least.
Yeah, and the other surprise, like you say, was obviously we knew Moran was going to go that way, but then the others, Bowman and Waller, you would have thought they would have been voting for a 50, and they didn't. That was yet another undovish bit of news there from the meeting. I think we'll hear from the pair of them this week as well. You put up the Fed calendar earlier in our chat room.
We'll hear from everyone this week.
We'll hear from everyone.
It's honestly meant to. I think it's something stupid like 18 or 19 different sets of remarks from various Fed speakers this week. I don't want to go on a rant, but in what world does that number of speakers benefit anyone? I would argue that's a classic case of too many cooks, and the messaging just gets blurred completely.
Yeah, that's as maybe. But it's always interesting the first speakers after a Fed meeting, and excuse me, Waller and Bowman. Those I think are going to be the most interesting because they didn't actually go for a 50, and we'll get to hear the reasons why, hopefully.
Well, one thing that is likely is that by not voting for 50 basis points, they've probably done themselves out of getting the top job next May. But we'll see how that race shakes out. There were a whole host of other central bank decisions last week. Ryan, why don't you take us through them? Yeah,
definitely. No real shocks from any of the others.
Except right. Well, there we go. Let's move on then.
Yeah, that's it. That's me done. Nice quick show, this one. No, there was a mini surprise from the Bank of Japan because we saw 2 dissenters there voting for a hike, and that's yet another step closer to a hike that may come over the coming meeting. So we could get one before year end, or at least early next year. Now, for banks and the Fed in particular, we sort of move on to a different plane now. The market was trading the expectation of where the Fed and others would see policy moving forward. The ECB look to be on hold for the foreseeable future. The Fed see 4 more cuts, with 3 this year, in total one next year.
Sorry. What was that about the ECB?
They look to be on hold for the foreseeable future. Doesn't mean forever.
I'll get my diary out then in that case and start making some lunch reservations, I think.
Well, you can do, but you got till the end of next year to make that reservation. So pick somewhere nice, and so it's
plenty of time to save up.
Yeah, you'll need to save up. You're going to go 4 for 4, mate. I tell you. But anyway, if I may continue, so the Fed are seeing a total of 4 rates by the end of next year. Again, which was perhaps maybe 1 or 2 less than the market was looking for going in, because we spent the last 2 weeks pricing into and repricing after all these announcements, and now we move back to trading the data. Now, this week gives the market its first real test of all that central bank messaging. We get the first PMI data of September coming out tomorrow or today when you see this video. And the data will be looked at by markets to see if that messaging is right. What central banks won't want to see now is data moving again the wrong way after their messaging for the ECB. They won't want to see weakening price pressures. The Fed would love to see weakening price pressures, but not a further weakening in employment. The Bank of Japan, they'll hope that this week's Tokyo CPI numbers, which is the first CPI numbers of the new month over there, they hold up as well to put them on their keep them on their path to potential hike. Now, while some of these data points on their own may not be huge news, coming so soon after 2 big weeks of central banks might make them a bit more volatile than normal, because it is a test for the market to ask whether they've repriced everything correctly or whether they have to price more or less than they have. And while the message from central banks is still fresh in their mind as well, now it's doubtful we're going to see any big moves, at least not compared to what we saw the last couple of weeks. But markets are now going to massage their expectations for interest rates based on what that data is going forward. So we're back to watching the data, and it's all important once again.
Yeah, I agree with you. I think it's more a case of the data we get this week is going to help us build that broader picture of the economic backdrop, as opposed to resulting in any sort of significant volatility on its own. At least the PMI numbers, I've been taking those with a pinch of salt for quite some time now. I guess the way I would frame it, particularly when it comes to the Fed, I guess also in terms of the ECB as well, is both are on quite established policy paths now. The ECB, very much the signal, not only from Lagarde, but remarkable message discipline from the rest of the governing council is we're done and dusted. Yeah, there's a few doves, Vilroy, for example, but primarily it's a case of we are done with policy easing. So as you say, it's a question of what now, if anything, moves them out of that stance and pushes them towards another rate cut. I'll tell you now, it's not going to be one PMI release, but it could just slowly be another piece of that jigsaw that does nudge them in that direction. It's the same thing with the Fed, and I think we can obviously talk about this more in next week's show. The Fed have said, basically, without using these words, we're not overly worried about inflation for the time being. We're going to look through it. We're focused on the labour market. So as a market participant, you've then got to ask yourself, okay, well, the base case is the Fed are going to cut certainly at the next 2 meetings at the back end of this year, probably at the first few meetings in 2026 as well. How strong does labour market data have to be, and how long does it have to be strong to convince the Fed that actually they don't need to be going down this path of sequential and consecutive rate reductions? Because again, we've had a negative payrolls print in June now because of the revisions, a soft one in July, a soft one in August. If September comes in at, let's say, 250,000, well, great, but it's 1 month. You need several months to confirm that the labour market has started to bottom out. So I think that's the way to look at economic data now. It's a question of, is it meeting the bar for these central banks to actually say, right, well, where we thought we were, we're not there anymore. We need to change what we had signalled and what we had thought we were going to be doing next.
Yeah, and it's the same on the other side. Let's say we see the jobs market really rolling over. Then the market's going to be 1 cut next year. You're massively underpricing that, Mr. Powell, and then you're going to see expectations growing. And then we get to the December FOMC and the updated forecasts, and we play the same game again as we did for September. So yeah, that's why as I say, data watching is going to be very important now, just to massage those expectations either way.
Yeah, absolutely. Just one last thing, I haven't got it in front of me. The whole one cut in 2026 thing, I think there's two reasons to be a bit careful on that, in addition to everything we've already discussed. One is the dispersion of the dots. Effectively, you've got some very, very hawkish and some very, very dovish on there, which means that the median ends up being, almost a compromise between the two. The second is there's probably an element in some, if not all, policymakers' minds of we don't want to panic the market too much. If, for example, the Fed came out with dots that had 75 bips of cuts this year, 75, even 100 bips next year, everyone in the market is going to go, whoa, hang on a second. What do you know that we don't know? And why are you so panicked? What are you so worried about? And that's actually going to result in the market having quite an aggressive tantrum. So I think there may be an element of that at play as well. But we can discuss that until the cows come home. We won't. What we will do is move on to the UK, because it was a busy week here in Blighty last week. The labour market data broadly as expected, unemployment holding steady at 4.7% in the 3 months to July, potentially a sign that the labour market is starting to stabilise a little bit. Inflation as expected on the headline, 3.8, although we did see that the core and services metrics come in a little bit softer. The BOE also pretty much as expected, holding bank rate steady at 4%, 7-2 vote, Dinger and Taylor dovishly dissenting as they always seem to. The bank also maintaining their guidance in terms of gradual and careful rate cuts going forwards, which implies an easing bias, implies quarterly rate reductions, but of course the September inflation data is going to be absolutely key for that one. The focus really, though, again here in the UK has remained on the gilt market, and it's again remained on government spending, which frankly remains out of control. Firstly, though, we did have a pragmatic decision on the balance sheet on quantitative tightening from the Bank of England last week. They're going to run down their balance sheet by 70 billion quid next year, which is 30 billion lower than it was last year. Also, although active sales are about 10 billion quid higher than they were last year, they're only going to sell a maximum of 20% of those sales at the long end of the curve, whereas previously it had been split equally, so a third, a third, a third. They've trimmed that back to 20%, which is a very sensible decision given the pressure that we've seen at the long end of the gilt curve in recent weeks and months. But frankly, that just sort of buys the government time to fix the fiscal foundations of the economy, and they don't seem to be showing any sign of doing that. They are still spending like a drunken sailor, to be completely honest with you. Borrowing in August at 18 billion quid. That is a 5-year high. 5 years ago was the pandemic, so I think we can probably excuse the figure from 2020. In the first 5 months of the financial year, which of course here in the UK starts in April, the government now borrowed 83.8 billion quid. That is the fastest pace of borrowing in the first 5 months of a financial year ever, again, excluding that 2020 pandemic year. So fundamentally, the backdrop is what it has been for months here in the UK, yet no one in the Treasury seems to have woken up to that just yet. Rachel Reeves is in desperate need of making some big spending cuts in the budget in order to restore market confidence. We've heard further news over the weekend of potential tax hikes, this time potentially looking at VAT on taxi fares. Why on earth would you do that? One, it's not going to raise any money. Two, it's going to be inflationary. Three, it's going to pose a headwind to economic growth, just like all the tax rises you did this time last year, and it makes the fiscal doom loop even deeper. Please show this to someone in the Treasury, because at this point, I think our heads are going to explode by the time we get to the budget on the 26th of November. One other thing that might explode before we get to the 26th of November is the pound, or gilts, or both. Safe to say the market did not take borrowing data particularly well at the back end of last week. I think cable's down about a big figure and a half, two big figures from the highs that we saw last Wednesday, Thursday, trading below 135 into the close at the end of last week. I'm going to talk more about this in a moment, but frankly, there's absolutely no reason to be long of anything UK related right now, apart from maybe the FTSE 100, but that's full of overseas earners and it should be insulated anyway.
Oh, it sounds like we need to be long an air ticket out of here, the way you're spinning it at the moment.
Well, yeah, maybe long Ryanair, EasyJet and British Airways are the play, just going to be inundated with bookings.
Yeah, well, maybe we need to take a little hop across somewhere. Maybe go and join Wesley down under if things are better there. But I definitely think we saw that switch in pound trading from looking at previous data and seeing it not doing too bad, including that retail sales data we got for August, which I expected to be good, and I expect that to maybe fall off a cliff in this month's data, which we'll get next month. So yeah, definitely the market took a bit more notice now of what's going on with Rachel Reeves, particularly in euro sterling. And I think this is something I've been trading for the last couple of months and just waiting and holding on to see if we get this negativity building into that budget in the latter part of the year, because I can't see the data really getting any better from here. So we've seen a bit of a break up in euro sterling. We got through that 87 handle. We're now today trying to break above a big level at 87.20, and this is a huge level. It's really the gateway to everything else above, and when we've gone above that level and held above that level, we've seen us gone into the 90s, 92s and areas like that. So yeah, the Bank of England, they did what they had to do. The data, it wasn't horrendous this last week, but neither was any of it really good, except for that borrowing data, which was awful. So I think for them, they're just in wait and see mode as well. If the data softens between now and the next meeting, then yes, we'll likely get a cut if it softens materially. But I can also see them maybe sitting on their hands until they know what Reeves is going to pull out the hat. It's not going to be good, and then maybe they feel the need to maybe go a bit stronger, at least in their language, if not by policy.
Yeah, potentially. It's funny you mentioned the market's woken up to what Reeves is doing. Do you reckon Reeves has woken up to what the market's doing yet? I mean, remember when I did that freedom of information request, the Treasury have only got 11 Bloomberg terminals. So, the chances are they've got absolutely no clue what's going on at this point. I think it's a valid point in terms of the BOE. I'm still clinging on to November, but my faith in that is diminishing by the day at this point, if I'm completely honest with you. Just need an appropriate time to change that call, not a random Monday afternoon. The other thing, just in terms of the budget, because I don't want this to turn into a Mike Brown on his soapbox bashing the government, but it is because of the way that
no change there then.
Well, quite because of the way that the Chancellor has decided that the OBR is God effectively. It means that even right now, we are, 2 months from budget day, there's absolutely no way that the Treasury can be putting together any serious policy proposals because they need to wait for the OBR's initial forecast, which doesn't come through until the 3rd of October, before they know what their fiscal headroom is or isn't, because it's all disappeared, before they know the size of this black hole that they need to plug. The whole process is completely backwards. And even those two very, you would consider these days comparatively minor things that I've just mentioned. If you're an international investor sat there going, get 30-year gilt yielding 5.5% right now, the 10-year gilt yielding 4.5%, highest yields you can get in G7. Do I have a nibble? Why would you? Honestly, why would you? What about any of that says to an investor, yep, that's credible, in I go?
Oh, well, apparently it's credible for America. Apparently it's credible for Canada, who are looking to invest in commercial property, but they're probably waiting for the crash to happen before anything else. But you say about Rachel Reeves waking up to what everyone else is doing. It'd be nice if she wakes up to what she's doing along the way sometime. But yeah, it's I've mentioned it before. I've probably never been as bearish on the UK before as I am right now. We've always managed to fight against the grain when people say we're going to collapse, disappear at our own backsides. We've pulled it out of the hat, but I don't see anything positive. We are in a doom loop. She wants to cut spending and raise taxes in a low growth environment. I mean, that's just economics 101 that you can't do that. So, yeah, I fear for the future.
Indeed. I am sadly with you on that one, mate, and I would imagine a lot of people watching this are as well. And I would hope that there is a way we can haul ourselves out of this one, but I'm not going to hold my breath. Anyway.
Maybe she'll win the lottery.
Oh, well, yeah, it'll have to be a bloody big jackpot to plug the gap that she needs to fill. Anyway, let's move on to the greenback, which has been showing a few signs of life recently.
Yeah, it's been under the cosh all year, the dollar, but now the market has really been able to gauge what's coming over the next few months, and it didn't or been able to gauge what's coming from the Fed over the next few months, and it didn't really get that Fed dovish slant. It's asking now whether it needs to continue selling dollars. Now, post-Fed, the market, I feel, is a bit more balanced, which means it needs some fresh impetus to sell more. As I mentioned in my prior topic, it may well get that impetus from future data points if it looks like the data is rolling over, and then making the Fed look a bit too optimistic in how many cuts it's going to have, and where they see rates going. Now, regular viewers will know I hate using the Dixie for any sort of technically predictive viewpoints. So I'm going to do that here. Or I'm not going to do that here. What I'm going to do is use it as more as what it should be used for, which is a historical view of the dollar and how it's fared in general. Now, to that end, we had sort of two almost identical patterns since April. And what we've seen then the first time around was a low, a bounce from that low, and then a retest of that low. Now, in the case of the first pattern, the second low knocked out the first low, and that wasn't a very bullish signal. And thus we saw a bit of a dead cat bounce followed by a break lower after that. Now, the second pattern, it did hold the second test of the prior low. Actually, it didn't, but that was a quick volatile move over the Fed compared to the prior one, which saw 3 daily breaks in the first pattern. So I'm going to give that one a bit of a pass and put it down to the volatility.
All the old technical analysts are writing in their letters of complaint as we speak, mate. You're riling them all up.
They can address those letters to you, mate, if they want to complain.
Now, mailbag's full already.
Yeah, bit more than Christmas cards you get. Now, I'm not saying the dollar has bottomed out, as you only have to look at its biggest basket in the currency, and that's the euro, to see that that's sitting very close to its prior highs. But generally, the dollar is bouncing. That prior low here and the current high in euro dollar is going to be very important if we retest either of those. Now, if we hold the low again in the Dixie in the dollar, that would be a very strong signal from that point that we've got at least a developing bottom in place. But even a marginal break there would suggest the bears haven't got into hibernation just yet. So look at those lows if you're watching a Dixie. Look at those highs if you're watching euro dollar to see if we're going to top or bottom.
Yes. Oh, for someone who doesn't like that chart, they haven't half waffled on about it, haven't you? Bloody hell. I think there are a few things I would add to that, though. Firstly is that, well, before the FOMC, obviously we've rebounded a little bit since, but the dollar, if you use the dollar index, or even if you use something like the Bloomberg dollar index, which is a bit more evenly weighted, we were down 10, 11% on the year going into the Fed meeting, which for any equity traders out there, you go, well, that's not a lot. But in the FX landscape, that is a humongous move. In fact, I think it was the dollar's second worst, or maybe even worse start to a year since the 70s, when we obviously had the Plaza Accord agreed and everything came off the gold standard. So we had come a very long way in a very short space of time, which I think meant that a lot of things were starting to get perhaps a little bit stretched in terms of positioning to the downside. The one thing I'm watching in terms of this rebound is whether or not we can clamber above and importantly close above the 50-day moving average, which is just north of the 98 figure in the dollar index. You can work out where that is everywhere else. If we do get above that, then that would be a sign of momentum starting to turn back in favor of the dollar bulls. But I think the way I would almost look at the dollar here is very, very similar to how I would look at the equity space. It's almost what is going to happen next in terms of why are the Fed cutting? Are the Fed cutting into a recessionary environment, or are they cutting into a non-recessionary environment? If the Fed are cutting into a non-recessionary environment, which I think is certainly my base case, and I would imagine it's probably yours as well, without wishing to speak for you, what you're going to see is the Fed leaning in to aggressively support growth. That could then lead to basically a return of this whole idea of US economic exceptionalism, growth in the US outperforming growth in the rest of the world. We go back to that side of the dollar smile and the dollar rallies away again. On the other side of that, if the Fed are cutting into a recession, that's firstly a much more risk negative environment, but it's also obviously a much more dollar negative environment as well, because it would suggest that the Fed are going to have to ease much more quickly and much deeper than the market is currently pricing. So I think it very much depends, from a fundamental perspective at least, do you think there's a recession coming or not? And my view is very much, this could be famous last words in 6 months' time. I don't think there's anything especially structurally wrong with the US economy or with the labour market. And actually, this looser policy backdrop could actually speed up the reacceleration that we've been talking about for some time now.
Yeah, and we always say you don't fight a market; it's got bigger pockets than we have. But when you look at something like euro dollar sailing up at its year's highs, you think, why is anyone buying the euro? They're not buying the euro because growth's been flatlining over there for 2 years, the same as the UK. So you can tell that it's all about the dollar, all about what the Fed's doing, all about what Trump's doing. And like you say, if things don't turn out to be as bad, and quite frankly, they aren't as bad. Before August, we were sitting here wondering where they're going to pull 2 rate cuts or pull 1 rate cut, let alone 2 rate cuts for the rest of the year. It only took a wobbling jobs market to put them in the position now. The rest of the economy is holding up fine. And as long as that stays that way, as you say, then maybe this is the time when we see a bottom in the dollar.
Absolutely. Well, we'll watch that one very closely. In the meantime, let's get on to our plays of the day. Right, I'm going to keep things relatively short and sweet because you can just rewind 5 minutes and find out what I've got to say about this one because we've rather already gone through it. But in any case, the UK is quite clearly still, a chart will appear, there we go. The UK is quite clearly still trapped in this fiscal doom loop of very, very slow, if not no, economic growth, an ever higher tax burden, which seems to be getting higher by the day, a government that is unable or unwilling or both to cut spending, borrowing ballooning as we saw in August, and frankly things are likely to get worse before they get better, particularly with the Chancellor having absolutely nothing resembling a credible plan to restore stability. It does feel, we were talking earlier, how do we get out of this doom loop? Is the only way out of it basically a reckoning from the financial markets? And it does feel as if that could well be on the cards at some point, whether it comes before the budget, whether it comes after the budget, whether it even comes early next year when it's clear that that budget hasn't worked, remains to be seen. But I think over the medium and longer term, momentum remains firmly and correctly with the bears when it comes to the long end of the gilt market. You've also got structural issues here as well, which are unrelated to the fiscal shambles. For example, the real removal and the stepping back of life insurers and DB pension schemes means that aren't those natural buyers at the long end that we've had for 2 or 3 decades, and that's compounding the issues that we see at the long end. So frankly, I see little reason to do anything other than remaining short the long end of the gilt curve, and just starting to wonder, and actually we spoke about this with Dickie Matthews last week, are we just going to gun for 6% on the 30-year and 10% on the 5% on the 10-year and get this over with sooner rather than later?
Could well do, mate. We could well do, but I'm not looking at that. You can rehash your stuff week after week, bashing the UK.
You're accusing me of a lack of effort, Ryan. That's a slanderous accusation.
No, I wouldn't make such an accusation much. Right, so yeah, I'm sailing away from the UK, or trying to. I've got my ticket out of here. I'm going across to look at Euro Swissy as my play of the day. Obviously, we have the S&B coming up. We've been stuck in this 0.92s, 0.94s range for a while. I'm looking to play the edges if the S&B gives the market something to move on. I'm mainly looking at the blue zone to see whether we trade to either side of that zone, but I'm not against looking below the bottom of that zone down to some of those extension levels you can see in the yellow and red zones. Now, obviously, traders will be thinking about possible intervention by the S&B if they do announce something or some big news, like going negative. But I'd like to remind people that they don't intervene like other banks do, like, for example, the Bank of Japan, i.e. coming in with a big hammer and hitting the market and forcing it down their way or up their way. The S&B are what we call smoothers. They'll just sit on the bid on any big CHF strength, or on the offer in weakness, and just soak up the pressure while also diversifying into currencies, usually euro dollar. They do have an impact, but don't rely on it to trade if you're trading over the SMB this week. So that's my play of the day for this one.
Very good. I think that's the first time anyone who is involved with the SMB in 2015 has described them as smoothing things, but there we are. That's a conversation for another time. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts and anything you would like us to mention in the show this time next week. And that is when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead, and we'll see you in a week's time. Goodbye for now.